Well, 2025 is in the books. There have been a lot of twists and turns along the way, but the markets and the economy are closing out the year much better than the experts expected. Let's dive into it. Well, 2025 burnt out my vocal cords, and if I'm honest, it was Monday Night Football, going to a Falcons game, and then walking back a mile in 30-degree weather. But we'll get on with it, and we got a lot to talk about today because there was a lot that happened. We came into this year, and the first couple months, the stock market started off on a pretty strong note. And then, as you can see on the chart here, the markets went over a cliff. That was during all the tariff chaos. The stock market dropped over 22% from high to low during that period. We did a lot of videos during that time, walking you through what was taking place. And the big call at that time was, would the economy go into a recession or not as a result of a lot of the uncertainty around the tariffs? We were in the camp that it would not, and thankfully, that's what turned out to be the case. No recession. And the stock market then set off on a nearly 7-month rally. There was no decline of even 3% during that period. And I'll tell you, part of that was a lot of the big firms that sold out during the sell-off was watching the market get away from them, had to buy back in. That is what took place. Then when we got into early November, we said a sell-off is overdue here. A 7-month rally is a long time to go. And the S&P then proceeded to drop 6%. The NASDAQ, which is tech heavy, was down 10. And then we have seen a rally from mid-November into the close of the year here. So all in all, a good year for the stock market. Now, every year we like to look at how did the experts do with their predictions of where the stock market is going to be at the end of the year. This chart we put up in early 25 in our 2025 outlook. At the time, the S&P 500 was sitting around 5,900. And as of the end of the year here, it's around 6,900. So a pretty good year for the markets. You can see that all these analysts were right in that they all predicted the markets would go up. And that would not seem like a huge round of applause, but it actually is, because as we've done this many years, they've been way, way off. But a lot of these firms cluster together. So down there at 6,500, you can see you had Citigroup, you had Morgan Stanley, JP Morgan, Goldman Sachs, all with the exact same price target, and they were off. The markets did a lot better than what they projected. Now, if you go on up, you will see some of the firms around 6,700 to up to 7,000 in that range. We'll say they deserve a round of applause. They did very well. They were not far off. This certainly, in the years we've been doing this, is one of the better ones for how some of these firms did. But it still is the case that the big firms were way off. Now let's take a look at the bond market, because it had been a wasteland for the bond world over the last 4 or 5 years. Don't forget, in 2022, the bond market's equivalent of the S&P 500 dropped almost 15% after never declining more than 3% in the previous 50 years. That caused a lot of problems for people in the bond world. This year, though, 2025 was outstanding, a strong bounce back. You can see the Barclays Aggregate Bond Index, again, the S&P of the bond world, and this consistently has been going up throughout the year as interest rates went down. So returns in the bond market are gains in the prices of bonds as well as the interest you are getting. So as we sit at the end of the year, this is up 7.38%, its best return by a long shot over the last 4 or 5 years. This is very helpful for portfolios that have a balance of bonds and stocks. Now, there were a lot of issues throughout the year that caused some volatility in the markets. There were the tariffs, there was the government shutdown, questions about the jobs market, yet the markets kept going up. And I got asked by some clients, why is the market going up? What's driving it? Earnings growth was the biggest answer for that. This is a chart that we have put up several times in the back half of the year that took a look at each quarter, what analysts thought profit growth was going to be for companies in the S&P 500 and what those profit growth ended up being. We're not going to spend a lot of time on this because we have discussed it a lot, but fourth quarter 2024 numbers that were announced early in the year in the first quarter, projected to be 12%, came in at 18.3%. Then we get into the spring. Projection for first quarter profits, 7%, comes in at 13%. We get into the summer for second quarter numbers, expected to be 5, came in at 12. And then third quarter numbers projected to be 8, came in at 13.5. I've said this before. I don't remember a year where basically the markets went 4 for 4 on earnings results. It's not uncommon to beat expectations by 1% or 2%, but these kind of beats are very unusual and they really drove the markets higher. Now, the other item on earnings that I want to point up, and this is just kind of a 30,000 foot view. This shows you 2024 earnings came in at $246 a share. 2025, this was analyst forecast, and you can see that's been steadily going up the last couple quarters. We're ending the year right around $271, and we're going to talk about this more in our Outlook video next week. But look at 2026, expectations of a big jump up to $313. And I'll call your attention to that red line because that is at any given time, what do analysts think profits are going to be over the next 12 months? And look, that line has consistently gone up all year. What does that mean? It means when you had a lot of these questions around tariffs, around the shutdown, the markets never thought that there was going to be a major economic turn down and a recession. Expectations for profits continue to go up, and that turned out to be the case. Now let's take a look at GDP growth, gross domestic product. This measures what the growth is for the U.S. economy. The first quarter, we saw a negative number. You can see the minus 0.6%. And again, this was taking place March, April of this year. And all the negative bearish analysts came out saying, hey, this is the start of a recession. Because again, the formal definition of a recession, back-to-back negative GDP prints. And we did a deep dive then and said the reason for the negative number was because so many companies here in the U.S. bought product, imported in product from around the globe, trying to get ahead of the tariffs that were taking place in April. When that comes in, that comes off the GDP number. And we said if you took a look at consumer spending and business investment, which is the most important reflection of what's really happening with the economy, that was an up number there. So we weren't concerned there was going to be a recession. Well, look at second quarter numbers, because again, a lot of people thought that was going to be a negative number. Instead of that, 3.8%, a monster. And just to give you context, anything north of 2% is viewed as a pretty good number for the economy. So 3.8, fantastic. Then just recently, we got third quarter numbers, 4.3%. So listen, this is much, much hotter than expected. I've seen it out there in a couple media reports that, hey, this growth is only because of AI. That is not the case. When you break it down, it has been a broad growth. We've seen it in industrials, financials, and yes, tech. So we like to see this. We hope it continues. Now, the last thing we want to mention on GDP, that was for the third quarter. For the fourth quarter, which we just completed, We turn to the Atlanta Fed. They have a tool that we reference called GDP Now. You can go see that yourself anytime. They take a look at all the data that's being published and give their estimate of what GDP is tracking. They're not always exactly right on, but it's a pretty good guess. Right now, they are expecting for the fourth quarter a 3% growth rate. And if we get anything close to that on the back of the 3.8 and 4.3, we're going to be going into 26 with a lot of momentum. Now, let's take a look at one of the categories that wasn't as positive as we went through the year, and that is the jobs market. This all centered around the amount of jobs added per month. You can see in the first half of the year there, we were in a range of 100,000 to 158,000. And then in the back half of the year is when the numbers started to get more negative. And a big thing that took place here was we were constantly having negative revisions. A jobs number would be announced for a month, and then the next month they would say, hey, it was actually much fewer jobs created than before. That was a problem. But take a look, even with the revisions, you'll notice over the last 5-6 months here, we have had 3 months where there have been net jobs lost. We've had a few good ones in there, 72,000, 108,000, and then in November, 64,000. So this is going to be a key factor as we make the turn, get into 2026. Can the jobs market strengthen? We'd like to see this number north of 100,000 on average. That's something to pay a lot of attention to. However, we don't want to just look at one data set with jobs to draw conclusions on how things are going. So we also have job openings. This is called JOLTS. And this goes back, this is a 10-year look. We all know that 12 million number was in the early days from COVID, where a lot of people were at home. There were great benefits for staying home, and companies couldn't find workers. 12 million job openings at that time. That's come back down. And right now, over the last year, we've been in a range of around 7.1 job openings up to 7.7 million. And last month, we got a pleasant surprise. It was expected to be 7.1. It came in at 7.6. That's an extra 500,000 job openings versus what analysts thought. As long as this is north of 6 million or 7 million, that means that there are jobs out there for people to get. That brings us now to the last jobs data set, and this is initial claims for unemployment insurance. We talk about this a lot over the last 3 years. This is very helpful because we get 50 states each sending in their information. When workers are laid off and they don't immediately find another job, they can go file for unemployment insurance. This has stayed in a narrow range for the last 3 or 4 years. This is what guided us, for example, in 2023, when 90% of economists were forecasting a recession. This told us, no, people have jobs, and we know people spend money here if they have jobs. Well, this is sitting at 214,000 last week. This has been very low now the last 4 or 5 weeks, meaning there's not a lot of layoffs happening out there. So when you take that along with the job openings, it tells us we'd love to see more jobs added, but in general, the jobs market is in an okay place. Now it's time for rapid fire. And this is where we go through a couple charts I think you need to know about. And we're going to start off with a chart of the Fed funds rate. This was a story in the first half of the year. Fed Chair Jerome Powell kept rates steady. There were a lot of people who thought rates should be cut sooner. It did not happen. But once we got into September, we had 3 separate cuts over the last 4 months of the year. You can see the Fed funds rate now is sitting at 3.64%. That is a range between 3.5 and 3.75. There are going to be further rate cuts in 2026 because we're going to get a new Fed chair. This matters because there are parts of the economy that have struggled a little more over the last couple of years. Small businesses, housing. And the hope is that with the combination of the cuts that took place late in 25 and the new cuts that will take place in 26, that will be the boost that they need. Now, the last chart here I want to cover is taking a look at Bitcoin and gold. And look, both of these assets, if you want to call them that, have major fans online and around the country. And there have been people who have said, hey, Bitcoin is like digital gold. And for the first 7 months of the year, they were about the same place. They were both up about 30%. But if you take a look, over the last couple months, there has been a massive divide. Gold has gone up. You can see there up 72% for the year. Bitcoin has dropped down 6%. Bitcoin declined over 30% from top to the bottom, which is not a surprise. Every year it typically has a big sell-off somewhere along the way. So we made the point, if you liked Bitcoin at 120,000, 125,000, and a lot did, that was not a good time to buy. You should love it here in the $85,000 to $90,000 range. That's just for those who liked it before. Now's a much better time to buy. As for gold, I want to highlight, we did a video on talking a lot about gold and the run it's had. Very important. You can see it there on the screen. Make sure you go watch the first 5-6 minutes of that video if you have not seen it. So that is a wrap on 2025, a good year for the stock market, a good year for the bond market, and we can only hope for much of the same in 2026. Speaking of that, next week we have our highly anticipated, well, mildly anticipated 2026 outlook, and we're going to cover a lot of exciting things. Hey, we want to say thank you. We came into 2025, we had 130 subscribers of our YouTube channel. We are now over 2,500, and the company itself, we have had a lot of growth. We just added a new advisor, Jonathan Brummel. Make sure to check him out. Last week, we published a joint video he and I did together. This is on portfolio red flags. And listen, if you're not a client of ours and you're wondering, hey, should we have a conversation? You can go right now to centeracapital.com and sign up to receive our newly published portfolio red flags. What we're talking about there are when we look at portfolio statements, what are the things that stand out? What are the things that are a cause for concern where we know we can help you a lot? So go check that out. We'll send that to you. Thanks for watching. Take care.